U.S. stocks falling from near all-time highs after equities capped their first advance in 4 months.
I'm going to do the Joe line, but the question is, what'd you miss? The 30-year-old bull market in bonds looks to be ending with a bang. The yield on the 10-year Treasury note saw its biggest monthly jump since 2009 as investors dumped debt offering yields near record lows. President-elect Donald Trump takes a victory lap in 2 Midwestern cities, symbolic of his surprise victory. He starts in Indianapolis, where he has proclaimed success at keeping manufacturing jobs at home. Mexico's richest person, Carlos Slim, says his country needs to focus inward after Trump won the U.S. election. We'll have his remarks later this hour. Let's get you started with a look at where the major indexes stand. As we head towards the close, we check in with Abigail Doolittle for more. Abigail?
Hi there, Scarlet. So we are looking at mixed trading still for the major averages here in the U.S. right into the close. We have the Dow trading nicely higher. In fact, on pace for yet another record close. But as we can see, the S&P 500 and the Nasdaq are both trading lower. So this divergence really stands out. And weighing on both the S&P 500 and the Nasdaq more so than the Dow are some of the technology shares. These include Microsoft and Facebook, both trading lower for a second day in a row. Kind of an under-the-radar screen sell-off in tech. Pretty interesting. But some of this could reflect a rotation out of technology shares, with investors taking the money out of tech shares and reallocating to energy on oil's big jump this week. Plus the financials. We have big strength in the financial sector. We have both J.P. Morgan and Wells Fargo trading nicely higher. The financial sector is the best performing sector for both the Dow and the S&P 500, helping to explain why the Dow is actually at a record high. And behind some of this, the 10-year yield shooting higher. Earlier today, up more than 10 basis points, really an extraordinary move on the day, but still up 6 basis points right now. In red, of course, price trades inverse to yield, so indicating a bit more of that sell-off in bonds. That, of course, November was the worst sell-off in bonds on record since 1990. $1.7 trillion came out of bonds. We have a great chart to explore this in the Bloomberg, which is #BTV5215. And this is a long-term chart of the 10-year yield, of course, trading down inverse to that 30-year bull run in bonds. The question is, what's ahead? So we do have the 10-year yield trading toward the top of that trading range, suggesting that maybe the spike in yield is nearing an end. This range does suggest it could go up to, call it 2.65%, maybe even 3%. But the bigger message here may be that we're going to see the 10-year yield consolidate this massive move. Of course, bonds are safe havens. There are some risk events ahead, including the Italian referendum, the FOMC. Maybe investors will sell the news, some saying that the market has done the Fed's work for itself. Another reason to think that this bond sell-off could end. The RSI here is nearing 60. And earlier today, a Bloomberg customer, Augustin Vero, also a technical and quantitative strategist, he said that the last 5 times that the RSI and the 10-year yield has gone to 60 or above, it has basically signaled a move back in the other direction as bonds rally, typically a period of 5 months, which he timed, interestingly, to the March FOMC meeting. So it'll be interesting to see what's ahead. But it does look like we may have this spike in yield cool off a bit in the weeks and months ahead, Scarlett and Joe.
Abigail, that's an important chart showing that the yield in the 10-year moving right back to where it was at the start of the year. Thank you so much, Abigail Doolittle.
What'd you miss? Let's get some more insight into the bond market route and everything else that's going on with Mark Cudmore, Bloomberg intelligence analyst, a former FX trader. Mark, thanks for joining us here. You're usually based out of Singapore. This bond sell-off, it's really the only story right now. It feels like everything is sort of, the 10-year yield is calling the shots from markets all around the world. We just have a headline, Bill Gross warning that the current market rally is going a little bit too far. Jeff Gundlach earlier skeptical about all these moves maybe getting a little bit too extreme. How do you think about things here?
I think the important thing to emphasise is that they're both, doubting the Trump motivation for the rally, and they're all saying, look, is Trump really going to deliver on all the expectations? And that's a very valid point. But I don't think this rally is all about Trump. It's important to note that the move higher in yields started before the election. The move higher in commodities started before the election. Copper reached its high up until about a week ago, actually the day after the election. It did 20% in the previous 3 weeks and then kind of hung around the same level. So to me, there was good news already before the election, and people were just waiting for that risk event to get out of the way.
So was that move up, and you can trace it back to late August, I think, for the 10-year yield. Was that move up driven by fundamentals, or was it a consolidation of some of the gains that we had seen in the previous 10, 20, 30 years?
I mean, I think there was genuine change in fundamentals. We were starting to see a little bit of inflation tick up. We were starting to see signs of, like, proper kind of wage inflation at an okay level. Nothing's running away, and I don't see any chance of inflation properly running away anytime soon. But we are starting to see a rise in input prices. We also saw Chinese import prices stop falling for the first time in a long while. So, there was a lot of good signs. Manufacturing data started picking up before the election. October was the best month of 2 years for global manufacturing. So the growth was there already, and this was just a risk event out of the way.
And speaking of manufacturing data, another really fresh round of data out today. Chinese data solid, European data solid, U.S. data solid, the ISM and PMI. It looks like for the first time in a while, all the regions are sort of accelerating nicely.
Absolutely. And, a lot of people say the moves have gone too far, too quickly, and they have gone very quickly. But it's important to remember where we've come from. I mean, in reality, the 10-year was out 2.3% last year, when the year ahead was looking terrible, in December last year, this time last year. And, a lot of these moves might seem quite dramatic, but that's only because we really reached extreme in the other way in the summer. So this is more just a normalization.
All right, if this is more of a normalization and the economic fundamentals, as evidenced by the PMI, supports or justifies the move, what about the strong dollar? Won't that come back to hurt us eventually?
I think so, absolutely. It's going to be self-correcting at some point. And I mean, the million-dollar question is, what level does it become self-correcting? Obviously, that's a disinflationary impact, and it starts hitting growth at some point. I don't think we're there yet, though.
One of the themes of this entire year has been political event risk. And we obviously had the Brexit vote, and people thought that was going to be a big deal, and it was for about 2 days, and then most markets sort of forgot about it. Then the election, again, it was like that time it just lasted a few hours, and then we saw equities off to the races. This Sunday, we have two big votes in Europe. The main one that people are talking about is the Italian referendum. People are worried that this could be the start of something big there. How are you thinking about this?
Well, I think, first of all, it's going to be less of a shock because expectations are so low. Everyone's convinced it's probably going to fail anyway. You're still going to get some headline noise. You're going to get some reaction when it's confirmed it fails. But I think this is a long-running story. Italy is a serious risk for the Eurozone, but it's not all going to happen in the next 24 hours after the referendum result. Even if it fails, will, Renzi step down immediately? Will there be a technocrat government? Will there be early elections? Even if the five-star movement are leading in the polls, will they get a coalition majority that supports leaving the Eurozone? All these things are, not certain, and they're going to take a long time to play out.
What does that mean in terms of how the euro trades, how the yen trades? Because the euro, a lot of people had been saying, has been moving south because of all these concerns, but there's just as strong an argument that it was really driven, the euro-dollar was driven by the dollar strength more than the euro's weakness.
Yeah, I think the euro is probably one of the hardest one to do because I think there's going to be a lot of volatility either way. And you also have some of the technical factors, like people are going to suddenly panic if you break below 105. Is that the charge for parity? And that might dominate some of the fundamental factors. You've also got ECB meeting next week. And if you do get a bit of a sell-off in Italian assets, what might the ECB do in terms of buying BTPs? And how will that impact the euro? So I think the euro is very hard to call. What I would say to you, though, that I don't see why any investor would suddenly go and sell Italian assets aggressively on a Monday morning. Yes, there might be some short-term reaction, but they've known for ages this was going to fail. This is not a new event, and this is not the right time of year to aggressively trade that theme.
What happens if the Italian referendum succeeds and Matteo Renzi stays in power? What kind of mandate does that give him?
I think that's actually a great question, because one of the things is I don't think it's properly been analysed or not properly understood. There's been a lot of research notes coming out this week saying it might be even worse if it passes for bonds, who knows. I think it's been completely unstudied because people are expecting it to fail. And in many ways, that will be a confusing outcome as well for investors. There'll be a bit kind of the relief rally in other assets. But for European assets, how do you trade them?
Real quickly, speaking of events, we have two coming up in the U.S. There's the jobs report coming out tomorrow. The data's been really strong, so people expect that a continuation. Then later this month, the Fed decision. Everyone expects the Fed to hike, but is there anything the Fed could say or with the dots that could really sort of change the trajectory of things?
Yeah, I think, everyone gets very obsessed by the level of the dot plot and how it's always seemed to be too high, and now we're wondering whether the market's catching up and whether that'll reconverge. For me, it's more like the evolution of the dot plot that's so interesting. It's, how is that slowly moving over time rather than the set level it's at? I also think the jobs data tomorrow is completely irrelevant. It has to really, really shock to be a driver.
And just to go back to the point of dots go, this is available on the Bloomberg here where you can see how it's moved over time. Let's just take it back to, let's say, March of 2015. You could see how the trajectory has changed here as the market and the Fed move a little bit closer together.
That was cool. That was like making a GIF on TV, like moving from frame to frame.
GIF or GIF? We haven't figured that one out yet.
But it is notable that the green line on that chart has now matched up with the blue line on that chart, showing a convergence for next year. There is no gap anymore between the market and the Fed.
And I think everyone will wonder is, will the dot plot shift higher again? Because there's always been that little premium. Or if it doesn't shift higher, what worries now? If the market ever gets ahead of the dot plot, suddenly people are going to go, the Fed's behind the curve. And I think, they don't really want to widen out the premium again. They want the market to converge, but they definitely don't want to risk the market getting ahead of them.
We'll keep an eye on that. And Mark Cudmore of Bloomberg Intelligence, great to have you on set.
Thank you.
Coming up, an exclusive interview with billionaire Carlos Slim. We talked to him at our Mexico Year Ahead conference. We get his thoughts on Castro's death and what's weighing on his mind the most with a looming Trump presidency. This is Bloomberg.
What you missed earlier today, Bloomberg's Eric Schatzker had an exclusive interview with America Mobile Chairman Emeritus Carlos Slim from our Mexico the Year Ahead 2017 summit in Mexico City. Eric started by asking him how he felt about Fidel Castro's death.
I think that he lost the opportunity to change Cuba. In '91, I was optimistic that it was going to happen, because if you remember, in '91 they need to go to the special period because the Soviet Union take out the support that they used to give them. So I went there to look to invest in the telecom company, and it looked for me very clear that things can change easy.
And it didn't happen.
And didn't happen.
Will it happen now?
I think one of the problems was things were getting together between U.S. and Cuba. Fidel, and that was in the government of President Clinton and Fidel Castro. But this action, when they get down a plane, you remember?
I do.
They changed everything because it was moving in the right direction.
But now that he's dead, do things change again? Do you see Telefonica, for example, sells wireless phones in Cuba? Could America Mobile?
When it opened, we are interested, by sure.
But it's not open enough yet?
No, the only countries we are not is in Cuba, Bolivia, and Venezuela, and some countries of the Caribbean. But we are everywhere in Latin America.
Will you think about attending Castro's funeral?
Excuse me?
Would you attend his funeral?
No.
No, you weren't that close.
No, I was there the last time, 2001.
So it's been quite a while.
Yeah. Well, I went for a visit like 2 years ago, 3 years, but like a tourist.
Now, Mr. Slim, to conclude, as you know, now and then, people mention your name as a potential candidate for the presidency of Mexico.
Not at all, never.
If Donald Trump can be president of the United States, why can't Carlos Slim be president of Mexico?
I am not Donald Trump. No, I think my vocation is like an entrepreneur, and many things. I don't have a political vocation. In politics, things happen very, very slowly.
Well, if it's not going to be you, there's an election coming in this country in 2018. What do you want to hear from the people who run from that office? What's most important?
Well, I will tell you better about today. I think it's very important that we have already a important law in transparency and corruption. Is very important. That's a point that we need to solve. And it was an interesting look Trump talking about that in Washington. I think it's something that happened everywhere and should be eradicated everywhere. That's a main issue. And the other is to have a good program, precise, not too ethereal, to make Mexico grow up. Mexico has lost many opportunities to grow since the last 30 years. The oil price, the interest rates down, the $150 of the oil, the investment in many things that have done. And what should be open is the private investment worldwide. I like that Trump talked about public partnerships of $1 trillion
for infrastructure.
For infrastructure. I have told here in the country many times, a few times since many years, the internal economy that I told before, but also create a kind of commission of infrastructure, a national commission of infrastructure, that the only job is to make that the infrastructure get developed and to sell the rights and the concessions to have the money to make everything, and with private public investment. And for that, we love that since now, not only after the next government, but since now, we move fast for the investments. We need economic activity everywhere. You need to make investment to have economic activity, and economic activity is who creates jobs.
Where are you most interested in investing your money today? What's most attractive?
Well, we are very interested in improve the development of our country and our countries, and that's what we are working in education and health. We are working strongly in the areas where jobs are creating. You cannot solve with philanthropy poverty. You can help creating human capital. You can create education, health, culture, many things around. Training, that is the program. But at the end, the only way is with jobs.
That was Carlos Slim, America Mobile Chairman Emeritus, speaking to our own Eric Schatzker at our Mexico The Year Ahead Summit in Mexico City.
All right, let's get you to our Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. Delta airline pilots have approved a contract that includes a 30% raise over 4 years. It may boost Delta's labor spending by $500 million in the first year. That is according to a JPMorgan Chase analyst. It could also lead to higher pilot wages at other airlines as separate unions look to match the gains. Visa is buying Cardinal Commerce in a move to improve security in e-commerce transactions. Cardinal's technology helps merchants and issuers authenticate card purchases made online. The acquisition will help the payments network giant improve security for customers paying through connected devices like phones and wearable devices. AngelList, the hit website for young startups looking to raise capital and product hunt, the one-stop shop for entrepreneurs looking to keep up with the latest apps, are getting together. The merger between two of the more popular sites in the Silicon Valley startup scene looks to make AngelList the best place to launch products and find early customers. And that is your Business Flash update.
Up next, was OPEC's surprise agreement to cut output actually the real deal? We'll show you why history offers reason for caution. This is Bloomberg.
Scarlet Food, what'd you miss? Well, the improbable deal by OPEC did get done yesterday, but the question now is, will everyone abide by it? And if you look at the past track record of the oil cartel, it's not great. So the blue line is the production quota, and as you can see, it's held pretty steady since 2009. Nevertheless, if you look at production, actual production, excluding Iraq, which is the white line, it's moved well above that. And Matt, if you can go to the very end of the chart, you can really see how production has taken off even as the quota has remained the same. And of course, this includes the period in which Saudi Arabia decided to go with a market share strategy first rather than a price strategy. Goldman Sachs actually says evidence of compliance could add $6 a barrel to its oil price forecast. Jefferies says what you want to watch for is compliance by the non-OPEC members, particularly Russia, which has agreed to cut 300,000 barrels a day, but it has some built-in excuses in case it can't get there, like technical issues. So that'll be something you'll want to keep a very close eye on.
So first they had a deal, then they had to hammer out the details, and now the question is whether they can actually stick to those details. All right, I'm looking at bonds because we've been talking a lot about the bond sell-off, treasury yields rising. Here's something staggering. Shoot, there's a pop-up on my screen, but it actually doesn't really matter. This is the Bloomberg Barclays Aggregate Index, which goes back to 1990. It's sort of like the S&P 500 for bonds. It's the ultimate bond index. It's just an incredible bull market over 30 years. But this month in November, if we focus down on this corner right down here, the worst month in the entire history of the index was this November. In 30 years of this index, which captures all these bonds all around the world, it's called the AG. It's the Bloomberg Barclays Aggregate Index. This was the worst. And now it's this huge question. Was this just a tantrum like in 2013, or is this the start of a reversal of this bond bull market? It is arguably the only question that matters right now in markets. You have to get this right. Keep an eye. Extraordinary month. We'll see if this is the start of something.
We've had
big.
a number of notable tantrums, though, in the past. I mean, look at 2013. Right. Yes, it looks modest in comparison, but you had it in 2010 several times, and, of course, 2008 as well.
Exactly. So it may just be a one-off. It may not be anything, but could be.
All right, stay tuned. The market close is next. Take a look at the major indexes with less than 4 minutes to go before the close. The Dow adding 67 points, 19,190. The Nasdaq off by 1.4%. This is Bloomberg. We're moments away from the closing bell. What'd you miss? The Dow Jones Industrial Average closing at a record high. Financial markets started the month with continued confidence in economic growth, with treasuries extending losses, the dollar sitting near a decade high as well. I'm Scarlet Fu.
And I'm Joe Weisenthal. I want to welcome all of our viewers who are turning in live on Twitter. You can watch our closing bell coverage on Twitter every weekday from 4 to 5 p.m. Eastern Time.
All right, let's begin with our market minutes. We have the Dow Jones Industrial Average closing at yet another record high. It gained once again, even as the Nasdaq declined, which is interesting because we've seen how industrials have really been the star performers since the election of Donald Trump.
That gap,
big tech has just flailed.
That gap, 0.36 up on the Dow and down 1.3 is a really big gap between the Dow and Nasdaq. And as you say, shows the gap between industrials and financials and energy, those big caps, and the tech, which has really been leading the sell-off.
The data today had been fairly encouraging as well for the broader U.S. economy. If you look at the breakdown of sectors, as we mentioned, the Nasdaq, the big loser here, and you can see that tech was a big drag on it. There's the sector ETF that tracks technology off by better than 2%. Apple declining on a report that the company has started reducing orders from iPhone 7 suppliers. IBM and Microsoft each down by at least 1.5% as well. On the flip side, among some of the gainers, we are seeing car makers advance after their November sales beat analyst estimates. GM posted a 10% sales gain for the month of November thanks to incentives. Ford jumping the most in 4 years, up by almost 4%. November sales for that company rose 5.1%. Of course, energy shares giving back a little bit of their gains after yesterday's OPEC production cut deal.
Let's take a look at government bonds. We have further sell-offs and higher rates. 1.15% on the 2-year, 2.44% on the 10-year. Both were even higher earlier in the day. Really starting to see an intense sell-off, starting to freak people out as the economic data and expectations of more inflation and stimulus pick up. And here's a longer-term chart of the 10-year yield going back 5 years. And you can see we're right there at levels where they peaked in the middle of 2015, summer 2015. If we could poke a bit higher, we'll be at levels we haven't seen since 2014. And if we could get up to 3% yields, then, and we're still ways from that, then we'll really be at multi-year highs. So that just sort of puts into perspective this Treasury sell-off that we're seeing. It's
been an incredible move. All right, well, the dollar taking a bit of a breather today. So here we're going to start with the British pound. There was speculation, maybe even hope, that the UK can keep its single market access to the euro bloc. Probably hope. Well, this all comes after the nation's Brexit secretary said the UK would consider making contributions to the EU to keep that access. David Davis didn't actually specifically mention making payments, but it's hard to see what other contribution there would be to keep that access. I also want to point out the Turkish lira. Its losses deepened. It's fell to a record low versus the dollar as well as versus the euro. That, of course, is adding to pressure to the central bank to step in and intervene, curb the losses by raising interest rates unexpectedly. And by doing so, it would oppose President Erdogan. But that hasn't changed the trajectory as well, as you can see the move there.
All right, let's look at commodities. Iron ore having another big day. Iron ore has been absolutely on a tear lately. Up more again today, more gains. NYMEX crude is just a huge 2 days in West Texas Intermediate after that OPEC decision yesterday to cut output up 3%. And then gold, not really doing too much, but it remains below 1,200 as people are sort of rotating out of these popular safety assets that were popular earlier in the year.
All right, those are today's market minutes. We do have some breaking news. Starbucks making the announcement that Howard Schultz is stepping down as CEO. He's going to be named executive chairman, and Kevin Johnson will now be the CEO to succeed Howard Schultz as CEO. Starbucks shares in the after hours plummeted on the announcement. It fell 11.5% post-market, and then it very quickly paired those losses to being down 5.5%.
Yeah, I have the chart here on my terminal. You can really see how quickly, if we want to bring that up, there we go, how quickly they dropped. We can zoom in here, and you could, 1 second. You can really see how sharp that drop was automatically. But then we, came right back. We're still down a few percent. I mean, I think this is a pretty big surprise. I hadn't heard anything about Schultz moving on to this role, but you can see market taking a hit, but, you know, not as much as it was initially.
It's important to mention that Kevin Johnson is a tried and true executive here at Starbucks. He's the current president and the COO, and he's basically expanding his role to the CEO. This is according to the company's news release. Howard Schultz will stay on with the company as executive chairman. He will also shift his focus, according to the company's statement, to innovation, design, and development of Starbucks Reserve roasteries around the world, expanding the Starbucks Reserve retail store format and the company's social impact initiatives. He will stay as chairman of the board of Starbucks. Do you try these reserve beans? I mean,
I've never had a reserve bean. I wonder, and as just speculating, I wonder if people are going to try to encourage Schultz to run for office at some point. Because every once in a while, his name is thrown out there. He's obviously very politically engaged. And so something
That's a good question.
Who knows? I'm just throwing that out.
All right. In any case, Starbucks shares down on this announcement that Howard Schultz is stepping down as CEO.
I want to bring in a chart on inflation. 1 second.
This is our deep dive here. And, of course, you can find the charts on the bottom of your screen using the function.
Here we go. It's a chart 4322 on the terminal, and it looks at various market-based measures of inflation break-even rates for 30-year, 10-year, and 5-year. And what we can see is that markets are starting to price in inflation that's getting pretty close to the Fed's goal. I mean, most actual measures of inflation are still shy, but they're going in the right direction. But markets are starting to see them getting there, which makes some of this pricing in of a likely rate hike in December and so forth make sense, and sort of this is the story in markets right now.
But it's notable that they all crossed the 2%, or I should say the white line crossed the 2% benchmark right after the election.
Yeah, absolutely, and it's just been shooting higher since then.
All right. The Bloomberg Economic Surprise Index paints a picture of data that is consistently topping economists' estimates. So what you're looking at here is the Eco Surprise Index. It doesn't actually show growth in the economy. It shows the extent to which data points is surpassing consensus estimates, and it's certainly been the case over the last couple of weeks and months. I want to bring in Ian Shepherdson, founder and chief economist at Pantheon Macroeconomics. And the data today, Ian, paints a pretty rosy picture of the U.S. economy. I mean, things seem to be working right now. And Donald Trump's election, in which we're going to move, presumably, to a more expansionary fiscal policy, kind of shifts us into overdrive.
Yeah, well, overdrive, that's not really where we want to be with unemployment at 4.9 already. So, yeah, we had a nice pop in the ISM manufacturing survey, the benchmark survey, the one everyone looks at very closely. It's not in boom territory, and 053 is not great. But 6-9 months ago, people were talking about manufacturing recession. That didn't happen. I didn't think it was ever going to happen, but it didn't happen. And now we appear to be coming out of it. And the reason is that massive downdraft in the mining sector when oil was down super low, that's finished. That's over. It's starting to come back. But just the fact that it's gone is allowing the kind of broadly favorable trend elsewhere in manufacturing to lift everything. You know, we saw the huge durable good numbers last week. We've seen jobless claims drifting further down. We've seen some of the hiring indicators rebounding. So here we are going into next year and stimulus with an economy that, to my mind, doesn't need it.
What do you think? Janet Yellen said a few weeks ago in a speech that there may be an argument for running a, quote, high-pressure economy. Running an economy in overdrive to sort of see where the tensions are, to perhaps boost productivity after years of sort of underinvestment. Do you buy that? Do you think there's any case for that?
I got some sympathy with it. I mean, I quite like the idea that having had years of low inflation below the target, running a couple of years with inflation above the target wouldn't be a tragedy. It would be an average target rather than a point that always has to be reached. Fine. It's a much more difficult hard sell politically, I think. I think Congress will regard that as breaching the Fed's obligation to pursue price stability. And the other problem is it kind of depends what your inflation chart looks like at the time you hit the target. Because if you just gently creep up through it and you can plausibly argue it won't go very high and let's just run with this, it'll be fine. Okay, great. What if you shoot through it? Because if you shoot through it and you don't have a plausible plan to bring it back down again, markets are going to be on your back. And you've seen already, as you were showing in the chart earlier, the pickup in break-evens, the rise in nominal Treasury yields, which has been startlingly fast. And this is all happening before any of the stimulus stuff actually kicks in. So what happens if we do it and then inflation goes up much more rapidly than anybody expects, and unemployment drops to 4.5%, 4.25%. There really is nobody left to hire. The productivity boom that we all hope, touch wood. What if it doesn't happen? Then you've got inflation.
Aren't we better, though, historically, at bringing down inflation than creating inflation? I mean, that was what everyone was saying 6 months ago.
You can always bring it down. but it hurts to bring it down. And that's the problem. So if you embed an overshoot, rather than just have a little bit that, fades away because you've done 1 or 2 hikes and that was enough, what if that isn't enough? Well, then you've got to move into a more traditional sort of tightening, the sort of tightening that everybody in the markets thinks is never going to happen again. And that is what triggers a recession, which you could have avoided if you hadn't pumped in the stimulus in the first place. But, of course, the Fed isn't doing the stimulus. This is Congress and the administration working in a way that the Fed, I suspect, doesn't really like.
So speaking of the Fed, everyone thinks they're going to hike this month. There doesn't seem to be any debate about that whatsoever. What about for 2017? Obviously, going into 2016, 4 hikes.
Yeah.
You didn't get anywhere close to that. Do you think we could get multiple hikes in 2017?
I'm pretty convinced that we'll get multiple hikes. It depends on the size of the stimulus, the structure of the stimulus, the timing of the stimulus. Right now, we don't know any of those things. We have no legislation. But once we get some, if the administration does what Trump's campaign said that it would do, then we're looking at a much hotter economy on top of a tight labour market to begin with. So you're looking at an environment where the Fed is going to move 3, 4, 5 times, depending on the speed, timing, extent of that stimulus. The market's not ready for that yet. The market's starting to think about it, but isn't fully ready for it by a long way. So the risk of a shock, an accident, the stock market is just flying. Valuations look very stretched to me. And the danger is that at some point we have to have a reckoning.
All right, Ian Shepherdson, founder and chief economist at Pantheon Macroeconomics. You're going to stick with us as we talk job data and a bunch of other stuff coming out.
All right, we just want to give you a recap of the breaking news that broke just a few moments ago. Starbucks saying that its CEO, Howard Schultz, is stepping down. He will remain as chairman of the board. He's going to be executive chairman. And Kevin Johnson, the chief operating officer and president, will succeed him. He will assume the role effective April 3rd, 2017. Starbucks shares falling in after-hours trade. This is Bloomberg. And just to recap the breaking news from moments ago, Howard Schultz, the CEO of Starbucks, is stepping down as chief executive. He is going to hand the reins over to his chief operating officer and president, Kevin Johnson. This will take effect in April, on April 3rd to be exact. Howard Schultz, though, will remain chairman of the board, and he will also be executive chairman. He will oversee things like innovation for the company. Clearly, it was a surprise to investors, and the knee-jerk reaction was to push the stock lower. It was down by double-digit percentages earlier, but Starbucks has recouped some of those losses and is now off by almost 4%. What'd you miss? Tomorrow morning, we're getting the final set of jobs data before the Fed meets for the final time this year. Economists surveyed by Bloomberg expect 180,000 jobs added in the month of November. And if you come inside the Bloomberg, we have the whisper function for people to enter in their own guesstimates. And what you have right here is, according to people who have participated, the whisper number is for 189,000, so higher than what the consensus estimate is, which is 180,000 there. The prior number, of course, is 161,000 for the month of October.
And if you have a Bloomberg, you can enter and be a champion with your guess. All right, we're still here with Ian Shepherdson, founder and chief economist at Pantheon. Thank you very much for sticking with us. What are you going to be watching for tomorrow's jobs report? Some people say it's not that interesting because the Fed's going to hike.
I got to say, it almost doesn't matter what the jobs number is because they're going to hike no matter what. It would have to be something mind-boggling. And if it is something mind-boggling, it would probably be because of some sort of quirk in the data. So I got to say, I think it'll be about 200, so I'm with your guys who are slightly over the consensus. So the seasonals are quite friendly in the fourth quarter, but the trend is probably about 175, which is good enough. It's not great, but it's good enough. You know, we were trending at 220, 225, so we've come off that, but we're okay.
One thing that theoretically could make a difference to the pace of tightening for the Fed is if it looked like there was more headroom on labor force participation.
Yeah.
And it looked like maybe there really were some sort of shadow slack in the economy and there were room to grow. Do you buy that? Do you think there's possible room to reverse in a meaningful way the downturn we've seen in that?
There's a big difference between possible and probable. It's definitely possible because it's fallen so far. It's stopped falling, clearly. It's probably picked up a little bit. I've got to say the monthly data are very suspicious. You've got to look at a run rather than a month. But it's possible. I kind of think, though, that given the way the companies are screaming about how hard it is to hire people, why wouldn't they have already pulled in these 2.5, 3 million people who've left the labour force? Why are employers not on the phone to these guys saying, come on, I've got a job? What they're saying instead is, we can't find the people we want, and wages are being bid up. Probably because for small businesses who are doing most of the hiring, the safest thing to do is to pinch someone who's working at a competitor. Pay a bit more, but you know what you're going to get, rather than pull in someone who hasn't had a job maybe for several years. So it's a huge unknown question. It is an article of faith among a lot of the people coming in the new administration that participation will rise very strongly and so we won't get rampant wage inflation. I hope they're right, but to have it as a base case, most likely scenario that everything's going to be great and we'll reverse this big drop in participation, I think it's a maybe rather than a probable.
So that being the case, are we at full employment?
We're close. Full employment, it's a kind of a movable thing, you know, we never quite know it until after you've seen it. You know, what defines full employment? Well, I guess it's the point where wage inflation goes nuts. That really is what tells you. And it's not doing that yet. It's picked up. We're running at 2.8. That was the latest number for wages after 5 years of 2. So it's moved up, but it's not crazy. So maybe there is some room.
And here we're looking at the various official survey measures. 180K for the non-farm payrolls, 4.9%. That's an expectation the unemployment rate will stay steady. Month-over-month gain in hourly earnings, 0.2% and 2.8% on the year-over-year earnings, which is key. And we have another chart that we swiped from one of your notes a couple of weeks back, which makes a very interesting argument that wages are going to pick up. Let's bring up that chart. I think it looks based on the NFIB, the number of companies saying that they have one or more job openings in white line, Atlanta Fed's measure in orange line. Tell us about this chart.
Okay, what it's telling you is that this is real wage growth. So adjusted for inflation...
it's real.
You see, if we look at the nominal numbers, which is the headline we get Friday, that looks low, 2.8. But in real terms, wage growth is dead in line with survey measures of companies, how hard is it to fill your positions, which is what it should be. So why are the nominal numbers so low? Well, because inflation's been so low. But the thing is, as we were talking earlier, inflation's now going up. So how do we keep those real wages rising, which is what the surveys say we have to do? Well, either inflation can go back down again, that's not going to happen, or the nominal numbers, which is what the Fed cares about, they have to accelerate. So this is a real-world, real-time experiment, really, and so far it's playing out because those nominal wage numbers have picked up. We had 5 straight years of 2% wage growth. Everyone got very bored by it. Nothing was happening. Now we're at 2.8, and I think by Easter we'll be at 2.4, 3.4.
What would a big infrastructure stimulus program do to wages?
They'd drive them way up. We do not have the sort of numbers of people for construction and everything else that you need for the sort of scale of infrastructure program that the new administration is talking about. So I have no doubt it would drive up materials prices, it would drive up wages, we'd end up with shortages in the construction sector in particular, where already construction companies are whining that they can't find the people that they want. It would be massively inflationary. The thing is, the tragedy is, you know, the Republican Congress is going to pass this infrastructure plan, a lot of these are the same people who 2-3 years ago wouldn't put a penny into infrastructure because it was being proposed by the wrong guy.
Politics works out like that.
Absolutely.
Well, it goes back to the idea that you were saying, Joe, which is we needed this infrastructure spending plan 5 years ago when unemployment was at 7%.
Absolutely. The time for infrastructure is when you've got the resources to do it, which is why you do it at the bottom of the cycle. You know, it helps to turn the economy around, and you've got the resources to do it in a non-inflationary way. What Congress did instead was actually cut spending. After the initial stimulus in 2009, we had the sequestration, where we cut defence and non-defence at completely the wrong time. So now they're saying, OK, well, let's reverse some of that, but it's now the wrong time.
What would be the best fiscal policy here at this point in the cycle? Is there anything in your view that Congress and the president, you know, there has been a lot of talk, monetary policy at the end of the rope. Is there anything that makes sense?
You know, what I would want to see now, if I had a blank sheet of paper and a free hand, I want to see a ton of federal money going into retraining, re-educating people who have been the victims of losing their jobs to China or wherever, the people who've lost out, the dispossessed, the people who voted angry in the election. Money can help those people. Government money can help those people. We're not very good at helping people who are victims of things, of those sort of forces.
All right, Ian Shepherdson, founder and chief economist at Pantheon Macroeconomics. Great to have you on the show. Appreciate you coming on.
All right, we want to recap the breaking news from moments ago. Starbucks has named Kevin Johnson CEO, and he will be succeeding Howard Schultz as CEO of the company. This was a surprise to investors who had sent the shares down in after-hours trading, although they have pared some of their losses as well. What's notable here is that Howard Schultz has had 2 separate stints as CEO, and so finally he is going to, I guess, retire would be the right way to put it, although the statement doesn't make that point. He's going to be stepping down, and he's going to be focusing on innovation instead. We'll discuss this further when we come back. This is Bloomberg.
Millions of homes.
Names its Chief Operating Officer Kevin Johnson to succeed as CEO, succeeding Howard Schultz. This is all effective on April 3rd. Schultz will move on to become executive chairman of the company. Joining us now for more is Bloomberg News' Craig Giammona and Bloomberg Intelligence's Jennifer Bartushis, who joins us by phone. So, Craig, tell us, first of all, do we know what Howard is going to be doing? I mean, yes, he will remain as chairman of the board, but really, where is his focus going to be?
I mean, I think the speculation right away is going to go towards politics. You know, his name has been bandied about for a while. He's active in sort of Democratic circles. circles, when you hear him talk, even if he's talking about coffee, he talks like a politician, somebody that, the race matters conversation that he did. So I think he has bigger ambitions. People threw him around as maybe a VP name in this most recent cycle. So I wouldn't be shocked if you saw him do something in politics.
Jennifer, Kevin Johnson, the new CEO, I mean, we see the market reacting slightly negatively to this news, probably just on the uncertainty of the transition. But what's the key thing to know about the new CEO?
Yeah, so the key thing really when you think about Kevin Johnson is that he has the operational focus that is needed to really help sustain Starbucks' growth trajectory. So he's an operations-focused guy. He's been involved with the operation for several years. He's been on the board for several years. And so, he should be able to continue to guide Starbucks along the path that it's on and ensure that it's maintaining operational excellence.
What about Howard Schultz? I mean, Craig mentioned that the speculation is he'll do something in politics, but could Howard Schultz move on to do something in retail? He certainly is quite the big player in the retail industry, disrupting, for instance, how Starbucks sold coffee, how the coffee industry operates.
It's true. I mean, he has a grand vision for revolutionizing retail, and whether he decides to use his energy and expend it in a political sphere, or whether it's in this greater sphere of how do we move forward and change the scope of retail, is yet to be seen. But he has very distinct views on the value of the roasteries that they're talking about opening over the next 5 to 10 years, the development of the Starbucks Reserve stores, which are more upscale and more consumer-centric. So there's a lot still to be done in terms of that vision, and I imagine that in the short term, at least, he'll be very occupied with making sure that those plans move forward.
Craig, Kevin Johnson, as Jennifer pointed out, has a tech background, used to be at Microsoft. Talk to us about where Starbucks is tech-wise, like what they've accomplished. I know their mobile app is big, right, and sort of what further opportunities they have down that front.
The bottom line is that they're a leader in, sort of quick service sector as far as tech. The mobile app is huge, mobile ordering. They've been ahead on all of that. You see McDonald's catching up. Chipotle is sort of really behind the 8 ball when it comes to that stuff. So they've really been a leader, and I think that's a big reason why Kevin Johnson is now getting this job. He was on the board. He's a tech guy. I think that's why they look to him as COO, because they realize how important this is. The daily coffee purchase, doing it on your phone, that's the future. And you see grocery stores, fast food restaurants trying to catch up and get to where Starbucks is.
Does Starbucks have technology that they could license out and scale or anything like that?
I'd be shocked if they did that, just because I think that they see that that's their advantage. That's the reason why they have all that customer data, of daily purchases, the ability to push digital coupons. It's just so important to their business going forward, and I think that everybody else kind of wants to be where they are. So I'd be shocked if they would sort of do something like that.
Yeah, in the past, when Howard Schultz has stepped down, Jennifer, the company has kind of wobbled a little bit. I mean, he had to come back and serve as CEO once again to kind of save the company. Is there concern, perhaps, that even with Kevin Johnson's credentials, he can't really keep the train moving in the right direction because only a Howard Schultz can do that?
Well, there may be some merit to the speculation, but at the same time, the entire management team is more solid than it was before, and so there are other resources and other people in key positions that are there to help support the overall direction of Starbucks. So the cohesion is a little bit more stable.
All right, Bloomberg News, Craig Giammona, and Bloomberg Intelligence's Jennifer Bartashis. Thank you both for quickly joining us on this breaking news.
Coming up, today's departure of Mexico Governor Agustin Carstens brought more volatility to the peso and is now raising questions about the future of Mexico's economy. This is Bloomberg.
I'm Courtney Collins. Let's get to Bloomberg's First Word News. President-elect Donald Trump is planning to nominate retired General James Mattis as the nation's 26th defense secretary. That's according to the Washington Post, citing people familiar with the decision. Mattis is a career U.S. Marine and a hawk on Iran. Following a 41-year career in the Marines, Mattis retired in 2013. Meanwhile, Trump was in Indiana today to tout the preservation of jobs at a Carrier factory in Indianapolis. Trump appeared with Vice President-elect Mike Pence, Indiana's governor, and issued a warning to U.S. companies thinking about sending jobs outside the country.
Companies are not going to leave the United States anymore without consequences. Not going to happen. It's not going to happen.
Carrier, a unit of United Technologies, agreed to keep about 1,100 jobs in Indianapolis, but it's still moving about 13 positions to Mexico. In exchange, the company will receive $7 million in tax and other incentives from the state of Indiana. West Virginia Senator Joe Manchin may be tapped for Secretary of Energy. That's according to Politico, citing 3 sources close to the discussions. But the conservative Democrat says he hasn't been contacted by Donald Trump's team and has no plans to travel to New York. Manchin has been a strong advocate for coal. French President Francois Hollande says he won't run for re-election. The move clears the way for his more popular Prime Minister Manuel Valls to enter the 2017 presidential race. Hollande made the announcement in a televised address, saying his lack of support opened the country to the risk of extremist movements. He becomes the first president since the Fifth Republic began in 1958 not to seek re-election. And a United Nations report says the world's population swelled to 7.4 billion this year. That report also focuses on the unique challenges faced by girls as the youth population soars. 89% of the world's 125 million 10-year-olds live in developing countries, where girls face obstacles to equal education, healthcare, and safety. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Courtney Collins. This is Bloomberg. Scarlet?
Unexpected news today from Mexico's central bank. Its Governor Agustin Carstens is resigning his post next year to run the Bank for International Settlement. That move moved the Mexican peso and is now raising questions about the future of the Mexican economy. Shortly after the news broke, Bloomberg's international economics and policy correspondent Mike McKee spoke with Mexico's deputy central bank governor, Manuel Sanchez.
I think it's a very, very important honor for the country and a privilege or a distinction, very well-deserved distinction for an extraordinary economist, an extraordinary policymaker who is Agustin. I think he is the best candidate for the post. It's certainly a loss for the central bank, but it's a big gain for the world economy. Well, let me say, however, that the central bank, all the decisions at the central bank, as in any other central bank, are made by a board. This board is part of the institutional framework of our central bank. So the institution should continue to operate as efficiently as it has been doing during the last years, since at least the autonomy granted back in 1993.
But he's been a major figure heading the bank since 2010. How much did Carstens drive policy? Did he do it in the same way that, say, an Alan Greenspan or a Ben Bernanke did for the United States Federal Reserve?
Well, he's a great leader, and he's an important participant at the board. He's the president of the board. Certainly is an important figure. It's very significant, his role, and his credibility certainly also has contributed to the ongoing increasing credibility of our central bank. But again, I would like to say that markets and observers should continue trusting the institution, because the institution is designed in such a way that the operation and the direction of monetary policy and all the different activities and responsibilities that the central bank has will be performed with all the efficiency that we have been exhibiting.
That was Bank of Mexico Deputy Governor Manuel Sanchez. We are now joined by Brown Brothers Harriman Global Head of Market Strategy and Global Head of Foreign Exchange, Mark Chandler. Mark, great to have you on the show. So much going on in the world right now, so I'm really glad you're here to talk about it all. But let's start with Mexico, really taking it on the chin as in the post-Trump world. How do you assess things right now, and particularly in light of today's news?
Yes, I think there's two big factors weighing on the Mexican peso, and it has nothing to do with what happened today. I'd say the two big things is Trump's election, but also the hikes in U.S. interest rates, which the market's pricing in. The market's not only pricing in the hike in December, but it looks like the Fed funds future strip is probably pricing in 2 hikes next year. And the Central Bank of Mexico, under Carson, has been raising interest rates to try to head off some of the inflationary pressures caused by the weak peso. Right. And so people are wondering whether they'll still be able to maintain that. But this is really a story much broader than that, and that is that emerging markets in general have been hard hit, and Mexico is really the proxy for a lot of emerging market currencies.
You know, it's kind of interesting because you think of treasuries and U.S. treasuries as the ultimate safety asset, and you think of emerging markets as kind of one of the ultimate risk assets, and yet they're trading simultaneously because long-term rates in the U.S. are so pivotal to this trade right now. Is this just going to be the story for a while, that U.S. rates is really going to be the main driver of all these international assets and currencies for a while?
One of the things I find useful on the Bloomberg terminal is doing some of the analytics with doing correlations. And so I keep an eye on how markets are moving together. Yeah. And so I recognize what you're saying is that the markets have become very sensitive to interest rates. But for me, that move really began probably in the middle of September. Right. And we're continuing. But at some point, and I suspect maybe by the middle of December, after the Fed raises rates, there'll be about some profit taking as people begin, okay, the Fed's not going to be able to raise rates in January or February if they just raise interest rates. So I think we could see some unwinding of this. But in the big picture, if you think that U.S. interest rates are going higher, whether it's because higher inflation from the higher oil prices, whether it's because of a large stimulus package when the U.S. economy is already growing to trend, whatever the reason is, it looks like a possibility that a 30-year, 35-year bull market in bonds is over. For most of my career, I've been seeing falling, on a trend basis, falling long-term interest rates. That might be over, and that is a big problem for emerging markets who borrow dollars, who are big debtors. Many of them are big debtors, borrow dollars, so it's going to cost them more to service their own debt and then to service their foreign debt.
This is really like a huge question right now, because obviously we had the 2013 taper tantrum. Then yields just kept going down. And as you know as well as anyone, strategists and interest rate forecasters are sort of famously wrong about the direction. Sure. Almost every year, they think rates are going to be higher than where they ultimately end up to be. But you think this really could be a key turning point, and this huge bull market that we've had for over 3 decades might be coming to an end?
I think so. I mean, for a couple of things are happening. One is that the deflationary pressures that gave us the last leg down in interest rates seem to be going away. Europe's not having deflation right now. Japan is, it matters how you look at Japanese numbers, but it looks to me like deflation has subsided. And of course, in the U.S., we're looking at close to the Fed's target. I think we're at 1.7 on the core PCE deflator. I think that the deflationary problem that we had has been eased, and then these other forces are beginning to kick in.
Well, we've had cyclical upswings across this huge bull market, so this wouldn't be the first time that we've had growth. It would seem like to break a 35-year-old trend, we actually have to have something regime change. Do we have that? Do we have something that really meaningfully changes this other than a sort of nice moments in the cycle?
Well, yeah, so you're right. It's possible that this could just be a cyclical upturn. But it could be something bigger. And you think about what President-elect is talking about. Yeah. This would be the first time in American history that we're not in a recession and we get fiscal stimulus. Right. It's not just that we get fiscal stimulus. It's that we get roughly the same package, same size package that we did in February of 2009 when the U.S. economy was cratering and we had 10% unemployment. So we're adding extra fuel, which I'm one of the people that do believe in infrastructure spending. I do think that more people can be working. A larger part of our workforce could be employed. But the kind of program that we're talking about right now seems to be, the market's sort of concerned that finally could really excite some inflation.
Right. So typically the pattern has been fiscal stimulus in this country is pretty minimal, and we only do it during downturns. 2009, there were a few times when Bush sent everyone a check. Both times it was sort of to get a weak economy going.
Exactly.
What really makes this different is that we're at 4.9% unemployment. This is not counter-cyclical. Strictly.
Exactly. And I would say the other piece of the puzzle that fit in is that same thing's happening globally. Europe, even though the Europeans are still having QE and maybe even expanding it next week, that they too are moving more towards fiscal policy. The whole world, I shouldn't say the whole world, but a lot of high-income countries, including Japan, moving more towards fiscal stimulus at roughly the same time.
So I want to get to Europe, but real quickly, how far could yields move in the sort of medium term?
Yeah, the idea of a 3% yield on the 10-year bond seems a bit far to me. But I don't see why we don't go to 2.5, maybe even 2 3/4, say by the end of the first half of next year. A couple of months of still moving higher. But remember, we were at 130 basis points on that 10-year bond back in like middle of September or so.
Right. Let's talk about Europe because there's a lot coming up. Italian referendum this Sunday, Austrian presidential election. We just got the news out of France that Hollande is not running, though he was at like 3% in the polls, so it's not a huge deal. But how do you think about these sort of developments ahead in Europe?
Yes, I think that what a lot of people in the market sees is they see 2 points on what they think could be a wave. The 2 points are the Brexit and Trump's election. And so we are looking at, the market, I think, is looking for the third point. Where is it going to be? And we think it's going to be in Europe, but we're not exactly sure where. A lot of people are focusing on Italy this weekend, partly because the Prime Minister, who's basically saying he could resign if he doesn't get what he wants. The problem I have is that this is not going to really change much in Italy. If he does resign, if Renzi does resign, there'll be another technocrat government. It's not the five-star movement, which is this populist, more nationalist movement that's questioning whether they should be in part of the Eurozone at all. I think that the real problem, the real challenge, I think, for people are going to be on Monday is not going to be the Italian election, or the Italian referendum. The Austrian election, it's likely, and the polls suggest, that the far-right candidate, which would be the first time a far-right candidate heads a European country, is president of a European country since the end of World War II. This would be that third populist point.
So this is the sleeper because almost, most of the talk is about Italy on Sunday, but you think the real story is what could happen in Austria on Sunday.
Exactly, because I don't think nothing really changes in Italy. I mean, eventually it will change.
People expect a no vote anyway.
Exactly. People expect a no vote. They're focused on it. And most recently, what's interesting is the Italian banks have rallied. The Italian stock market has outperformed, I think this week it's outperformed the other markets, and Italian bonds have bounced back as well. And so bounced back meaning relative to Germany. And so for me, the market is focusing on Italy when the thing that's going to hurt us is going to be in Austria.
Mark Chandler, Brown Brothers Harriman, Global Head of Markets and Strategy and Foreign Exchange. Thank you so much. Awesome. I feel like we did a great tour around the entire world, economy and markets. Thank you very much.
Thank you.
And coming up, mortgage rates are back in focus as they continue their upward trajectory following President-elect Donald Trump's victory. So is the 30-year decline in U.S. mortgage rates gone for good? A kind of continuation of what we were just talking about. More next. This is Bloomberg. What you missed, the bond market sell-off following Donald Trump's victory has prompted mortgage rates to rise, but further increases could stunt home sales in the next few quarters. For more on this, let's bring in Bloomberg Intelligence U.S. economist Yelena Shilietova. Yelena, thank you very much. So, everyone's excited. Stimulus, economy is coming back, but housing is an important part of the bull case on the U.S. economy, or at least it has been, and higher rates don't exactly help the housing market. So what's the impact?
So, yeah, everybody's so excited about economic growth next year, and we're all expecting some fiscal stimulus to help overall economy. And that's why the economy will be on a better footing. So the impact on housing could be a little bit more muted this time around. But let's look back and compare it to what we saw after the taper tantrum just a few years ago. So the increase in mortgage rates back then was about 1 percentage point, and that actually hurt housing quite a lot. We saw a decline in home sales, which actually resulted in a decline in broker commissions.
There we have the chart, and obviously the 30-year fixed rate moves in lockstep essentially with the 10-year Treasury, or, it's all basically the same thing. So that back in 2013, we said that was the taper tantrum. Theoretically, this could be about the same size, maybe more. So what was the impact?
Right now, we see the increase in mortgage rates is half the size of what it was back in 2013. So far, it's still smaller, so maybe not as much of an impact. But if we move to the next chart, maybe we can actually see that back then it was...
Here we go.
Right there.
What are we looking at?
Back then, when we had taper tantrum, what happened was home sales declined, both new home sales and existing home sales, and that resulted in a decline in so-called broker commissions component of GDP. And that component subtracted almost a percentage point from GDP growth back in 2014.
What does it do to prices?
Well, what does it do to prices? Well, theoretically, it should dampen prices a little bit as there's less demand. So it's a supply-demand dynamic there. So right there, we might see some flattening in prices.
I have a chart that I've been tracking on the Bloomberg, if we can bring it up here. It's a 30-year yields is the green line, and then the blue line is the year-over-year change in the mortgage refi index. And you can see it tracks very nicely, and it makes sense. No one no one's going to refi when rates are going up, or obviously that removes people who would. How significant is refi activity in terms of consumer spending? Is it
I think at this point in business cycle, and at this point like after the Great Recession, it's really not as significant as it used to be. So mortgage refinancing activity is not nowhere near the levels that it was back a few years ago.
So overall, when people talk about housing, one of the main bull arguments for housing is just that after years of, we're just underhoused, that there was such a collapse in housing activity in the financial crisis, and there's all this demand from millennials and household formation that we have to build a lot more. Now we have this slight headwind, or could turn into a bigger headwind with rates. So ultimately, looking ahead to 2017, which wins out? What are the biggest forces?
I think I'm still optimistic on housing. Housing did not contribute much to this year's growth. We could probably see a little bit of a support next year. And just because overall economic conditions are improving and people will be earning more money, and we're nearing full employment. So that overall growth in the economy should help housing and should offset the headwinds coming from higher mortgage rates.
All right, Bloomberg Intelligence senior U.S. economy Yelena Shilietova, thank you very much. Great topic.
Thank you.
Looking forward to following your stuff in the new year. Up next, Donald Trump is celebrating his deal with Carrier to save over 1,000 U.S. jobs. He just finished speaking outside the plant in Indiana. We'll tell you all about it next. This is Bloomberg. I'm Joe Weisenthal. What'd you miss? There's a major shakeup at Starbucks. Howard Schultz is stepping down as CEO next year. The high-profile executive built the coffee empire over the past 3 decades and served 2 separate stints as chief executive officer. He's being replaced by COO Kevin Johnson. Schultz will stay on as executive chairman. The move is likely to renew speculation that Schultz will seek public office. Starbucks shares are down in after-hours trading. And in politics, President-elect Donald Trump spoke outside the Carrier plant in Indiana. He celebrated his recent deal with the company to save over 1,000 U.S. jobs. Joining us now for the latest on the Trump transition is Bloomberg Politics reporter Alex Wayne in Washington, D.C. Alex, thanks for joining us. So, I mean, this is like great politics for Trump, right? I mean, details aside and whether this is scalable on a national scale, I mean, this is just great for him, right?
It's a masterstroke, absolutely. He's gonna deservedly garner a lot of political capital for this move. Not many presidents have ever been able to claim that they saved 1,000 jobs even before they entered the office.
So what's next? I mean, is this sort of? He said during his speech that he liked doing this. He enjoyed getting on calls with CEOs. He didn't mind if people called that unpresidential. He said it is presidential. It doesn't matter. Is this sort of a model for how we can expect the administration to operate?
If you take him at his word, it is. He dismissed the idea that it's unpresidential to call company executives and try to bend their elbow to get them to stay in the country. He said that any company that declares that it's considering a move outside of the United States is going to get a call from his administration. And if they do move, there's going to be, quote, consequences.
There are obviously critics out there. Let's President-elect of the deal, Senator Bernie Sanders, published an op-ed today saying that Trump, quote, has signaled to every corporation in America that they could threaten to offshore jobs in exchange for business-friendly tax benefits and incentives. That seems right. It seems like there's definitely a moral hazard thing here where you say we're going to go to Mexico unless you give us some sort of payment.
It's a pretty sweet deal for Carrier's parent company, United Technologies. They are, in fact, moving 1,300 jobs out of Indiana to Mexico. They're keeping 1,100 there. They get $7 million from state taxpayers. And United Technologies gets some credit with the White House. They're a big federal contractor. They build engines for jet fighters and all sorts of other stuff. They've now got a friend in the Oval Office.
Are there any conservative critics of this move? I mean, I know that, for years they talked about not picking winners and losers and free market and all that stuff. Is that wing of the party sort of just going to go slink off?
Well, look, I'll tell you that we seem to have a little trouble getting Republican economists to call us back on this story. So I don't know whether they're just, maybe they were just busy, but maybe they are trying to sort of avoid public criticism of the guy entering the White House right now. This is absolutely against Republican orthodoxy for the last couple of decades.
Real quickly, any news today that's interesting on the cabinet selection process? Anything that we should know about?
Well, there was a report today that General Mattis has been named as defense secretary, or will be named as defense secretary. But interestingly, Trump's communications director shot that down on Twitter just a few minutes ago. They don't usually do that. So that suggests they may actually still be considering this position.
All right. Alex Wayne of Bloomberg Politics, thank you very much. Coming up, what you need to know for tomorrow's trading day. This is Bloomberg. don't miss the big jobs report tomorrow at 8:30 a.m. Eastern Time. And then right after the jobs report, we'll get Fed Governors Lyle Brainerd and Dan Tarullo speaking at 8:45 and 1 p.m. And tomorrow, a big interview you don't want to miss. Our Bloomberg editor-in-chief, John Micklethwaite, will sit down with IMF Managing Director Christine Lagarde in a wide-ranging interview about the global economy at 1 p.m. Eastern, 6 p.m. London time Friday. It'll be on Bloomberg Television and radio. And that's all for What You Miss. We'll see you back here tomorrow. This is Bloomberg.
I'm Mark Halperin.
And I'm John Heilman. With all due respect to those people who are floating the idea of Chris Christie being the new RNC chairman, we have 5 words for you.
Sit down and shut up.
Bonzi liked the cold open. That's important. We like that. All right. On the show tonight, Trump's transition team, a Capitol Hill love scene, and one lean, mean Howard Dean. But first, it's been 23 days since Donald Trump became the next president of these United States. And while we've heard plenty from Trump thanks to ye old Twitter machine, we haven't seen him very much until today, when he held his first public event since his